Okay, now we are going to look at an example of RI. In this case, we are going to see the comparison between RI and RY and see why some people use RI over RI. Let's suppose there is a inn company, Hospitality Inn, which have 3 hotels, and one of them is in San Francisco. In 2024, the San Francisco hotel income investments was $240K and $1 million, respectively. And the Hospitality Inn is considering upgrading the room features and furnishings at the San Francisco hotel. That upgrade will increase the operating income of the San Francisco hotel by $70,000 and increase the total assets by $400,000. So before the upgrade of RI, let's say the pre-upgrade RI is $240K over $1 million, so 24%, right? But post-upgrade, now on the numerator side, we have to add up the incremental income of 70K. And on the denominator, we need to add up the incremental asset of 400K. And so the post-upgrade RI is actually less than the pre-upgrade RI, right? 22.1%. So if we rely on the RI number, then the manager may say, hey, we shouldn't be upgrading to a new room feature because it's gonna lower our RI. But then, how does it look like in terms of RI? So pre-upgrade RI looks as the following. Let's say the minimum required rate of return is going to be 12%. Okay, so then it's going to be 240K minus 12% times 1 million, reaching $120,000. After upgrading RI, then it looks like as the following. So 310K comes from 240K plus 70K, right? And the assets also increase, right? So 1 million plus 0.4 million gives us 1.4 million. With the same minimum required rate of return, our post-upgrade RI is going to be 142K. So actually, although our RI has lowered down from pre to post, in terms of the dollar amount, it actually increases by $22,000. Therefore, the company manager has to accept the upgrade opportunity, right? And that will achieve the goal congruence. What does it mean by goal congruence, by the way? Goal congruence means, let's say here, there are 2 types of parties, which is the San Francisco hotel and the Hospitality Inn. These are 2 players. Where San Francisco is kind of an agent that is working for Hospitality Inn, and Hospitality Inn is a principal, like the owner of the company, right? So in this case, we want to align the goal of the 2, right? Meaning when the San Francisco makes a certain choice, that choice should elevate the performance of the Hospitality Inn overall. But if the choice made by the San Francisco does not elevate the performance of the Hospitality Inn, then we say it as goal incongruent. So we will also mention goal incongruence or congruence in chapter 23, where we talk about the transfer pricing. So I'm giving you the preview of what the goal congruence means here. This is a hypothetical, another example of RI. Now let's say it's a retail division of Zephyr. It has an operating assets of 100,000 and requires a minimum return of 20% of the assets. The division earns $30,000. Okay, so the operating assets is 100,000. Minimum required rate of return is 20%. So in terms of the dollar amount, the minimum required rate of return is $20,000, right? So our residual income is going to be $10,000. So that is the retail division side right here. And let's say the wholesale has 1 million, right, as operating assets with the same required rate of return as 20%. Actual income is $20,000. So after deducting the minimum required rate of return, it's gonna be $20,000. So if you don't know anything about RI versus ROI, you may falsely think, oh, wholesale is a better business than retail. But in fact, it's not. Why? Because here we are missing ROI. The retail division earns 30% of ROI, but wholesale only 22%, right? So what does this mean? We have to see ROI and ROI side by side in any cases, okay? There is a advantage and disadvantage of each measure, which can be complemented by each different measures. Okay, now this is the last part of the financial metrics, which is the EVA. So EVA is a part of the residual income. It's a variation of the residual income model. So as you can see, it has a similar pattern. This is the income part. This is the asset part. Here we have the return part. And interestingly, the EVA is an income that is left to long-term holders, long-term capital providers. Meaning, we're not going to take into account how much income goes to government. So the tax part is going to be at all subtracted. The only part comes from equity shareholder and debt holder. Okay. So both of which should be long term. Meaning there can be some liabilities that the company can make for a very short term. So that's called current liability. Okay, so this can come by financing within 1 year. And these are people that the company has to pay within 1 year. So these are not the long-term capital providers that we don't want to consider here. Why? Because from the EVA concept, we are only interested in people that are actually owning the company, that has the ownership. But if these people are included, they are actually not necessarily having a higher stake in the company. They're only there within 1 year. So they're not the actual owner of the company. So we only want to focus on how many returns on these equity holders and the debt holders. So that's the point. Then how does the model look like? Well, in terms of income, instead of using EBIT, we focus on EBIT times 1 minus tax rate, meaning net operating income after tax, which we also call as NOPAT. Net operating profit after tax. Why? Because, as said, we want to leave off the government part. So we want to leave off the tax rate. Okay? Makes sense? And then how about for the asset part? So we're saying we only want to look at the assets that are for the long-term capital providers, right? And one thing to note here is that unlike the RI or ROI, it's not necessarily the operating assets we're talking about. We are thinking that, all the long-term capital providers hold all the assets except for the current liability part, which is for the short-term debt providers, right? So out of the total assets, we only want to leave off the current liabilities. Okay? And then for the weighted average cost of capital, this is the part that may be complex. This is in short called WACC. And this includes the required rate of return for both the equity and debt holders. Why? Because we are interested in how much return provided to equity and debt holders, right? So WACC is a more sophisticated version of CAPM. Then how does the WACC look like? Well, WACC looks like the following. So it's the market value of equity over the total firm value, which is the sum of the market value of equity plus the market value of debt. So that's V. So it's essentially we want to do the weighted average of the cost of equity and cost of debt right here. But if we only do RE plus RD over half, then we are not taking into consideration how much out of the firm value is coming from the equity holder and how much is coming from debt holders. So instead of doing these equal weighted average, we want to do the weighted average based on this market value of equity and market value of debt. Okay, so it's basically the market value of equity over the firm value times the cost of equity plus the market value of debt over the total firm value times the cost of debt. Wait. But then there's one part that we need to also take into account, which is the 1 minus T. Why? Because this part is already the tax deductible part. So this is a bit tricky, but let's say you pay an interest expense. You pay an you pay an interest expense. Let's say you have an operating income of 10,000. When you are paying tax, let's say it's 30%. Then if it's not tax deductible, then your tax is going to be $3,000, which is coming from 10,000 times 30%. But if, let's say, interest expense is tax deductible and your interest expense is 1,000, then it means that when you're calculating tax, you can deduct interest expense from operating income. So that you are applying 9,000 instead of 10,000 when you're calculating the tax. So it's going to be 9,000 times 30%. So $2,700 instead. Okay, so you get like a tax favor by the government. Okay, so because this is the part that you already get favor from the government, you want to also leave out that part by taking 1 minus t. So the cost of debt, if it's 10% raw, and your tax treatment is like 30%, then it's going to be 1 minus 30%. So your net cost of debt is going to be 7% instead of 10%. Okay. So that is because you get a tax treatment from your government. Okay, so the cost of debt is a bit tricky. Then how can you calculate the market value of equity? Well, the market value of equity can come from, again, the CAPM, as I've shown you. I mean, there can be a different model to show the market value of equity. I'm talking about the cost of equity. So the cost of equity can be calculated based on CAPM. And cost of debt is based on a contract between you and the long-term capital providers. So this is specified under contract. Okay, now let us move on to calculating some RI, and some other things. Redmond Awnings, a division of Wrap-Up Corp, has a net operating income of $60,000. Average operating assets of $300,000. So, and the required rate of return is 15%. What is the RI? So, before looking at the solution, please try to review by yourself first, and then come back to the video. Okay, so the ROI is going to be the net operating income of $60,000 over the average operating assets of $300,000. So that's going to be, if you calculate this, 20%, right? Now we have a same example, but now, let's say that if the manager of the division is evaluated based on RI, will she want to make an investment of $100,000 that would generally generate additional net operating income of $18,000? Okay. So now, how does the post-RI look like? So the net operating income will now increase by 78. Okay. And the denominator will increase by 400K. So after the calculation, you will get 90.5%. So pre-RI was 20%, post-RI is 19.5%. So based on the RI, you will be rejecting the investment opportunity. But what if you're using the residual income instead? It's the same question. Then would you be able to generate additional operating income, right? So it depends, right? So let us look at the residual income. So pre-RI was 60,000 minus 300,000 times 15%, right? So how much is that? this is 45,000, so $15,000. Post ROI, how does it differ? So it's going to become 78K minus 400,000 times 15. This part is going to be 60,000, right? So you can see that it's going to be $18,000. You see a $3,000 net additional income. Therefore, you're gonna say yes in terms of dollar amount. Okay, now let us move on to similar case. Oh, yeah, actually this is something that I've done right here, the residual income part. So this is 15,000. And here, you can also do based on the incremental income approach. So instead of doing this, pre-RI versus post-RI, you can only use the incremental income and incremental investments. So here it can be 18,000 minus the $100,000 times 15%. So $3,000 in incremental residual income. So again, yes. Now, we want to look at what's called a balanced scorecard approach. The balanced scorecard appeared in early 1990s by the management theorists called Robert Kaplan and David Norton. The reason why this was coming was because they thought that first, the organization's mission and strategy is not aligned with the performance measures correctly. So they want to actually, align the mission and strategy with the metrics. But they are saying that financial performance measures are not necessarily aligned, or they're not sufficient to be aligned with supporting the mission and strategy of the company. 네, 여보세요? Sorry. Okay, so where was I? Yeah, so instead of just looking at financial, they're saying, why don't we incorporate the non-financial measure as well? Okay, and then we want to align with the company's mission and strategy. So they highlighted what is the disadvantage of only focusing on financial measures. First, it's ignoring the complexity of the business, right? The business is not just can only not speak to the financial performance. Sometimes the business can be spoken better with customer voices, employee voices, which is not in the financial measure, right? And nowadays, financial measures are getting decreasing usefulness by investors. Why? Because the business environment is changing. Now there are more stakeholders than just investors who are, of course, focusing on financial measures. What are the stakeholders? I mean like labor union or the employee of the company. It can be a customer, it can be a supplier. They can all be a potential potential stakeholder of a company. So less and less people are focusing only on financial measures, but they're more focusing on other metrics. Nowadays, it's all about people business. So it's all about how we can manage better intangibles, right? And intangibles cannot be quantified only through financial measures, right? So what I mean by intangibles, like customers. It can also be about how innovative the process is, how efficient the process is. So process innovation is all about in the value chain. how fast can we bring the product to a customer with a better quality, with a low cost. That is about innovation of a process. Intangibles is not only about customers, it's also about employees. So are employees satisfied? Are employees getting more better learning from the company, right? And another important thing is that financial measure is a lag indicator that shows the results of the past. It's not showing the indicator of the future, right? So if you're in a growth company like big tech, you may be having a lot of expenditures. So your income may be even showing a loss. But that doesn't mean you are going to continuously be a loss-making company. You're making an investment in expenditure to do better in the future, right? So you cannot fully rely on only the financial measures, right? So that is a limitation of financial accounting. So there is a lot of debate in the accounting research area how we should see R&D expenditure. Because R&D on the financial statement, on the income statement, it is an expense, right? So as an investor, you see, oh, expense is bad for the company because it shows loss in the income statement. But in the long term, more R&D can give you more long-term opportunities, right? Long-term growth. So it's actually can be beneficial in the long term. So how can we see R&D expenditure, right? It's shown as a lag indicator, of course. It's shown as an expense, but it is actually a long-term benefit. So if you only rely purely on the financial measure, expense as an expense, asset as an asset, then it can be not fully representing your long-term performance. And people are saying non-financial measure like the customer experience, employee ratings, they are better indicator for the future. Okay, so how does the balanced scorecard or the BSC work? It usually starts from top down, meaning first it starts with mission and vision of the business. I'll tell you later about what the mission and vision is, but here, mission is about why we exist right now. It's about the current us, current being. Vision is about the future. So where do we want to be in the future? Okay, so both are always together. So you want to first start with why we're here. What do you want to do in the future? Based on that, you want to implement a core strategy, right? Like, do we want to be a cost leader, right? Do we want to differentiate our product? This we have learned in chapter 1, right? So all these strategies. After having a strategy, we want to have a metric, meaning we want to quantify what is going to be our target for this strategy and mission, what is our actual results, right? So these metrics should be both based on financial and non-financial. And the performance indicators are coming from 4 different perspectives that we will learn below: financial, customer, internal process, and learning and growth. So there is actually a sequence here. In order to have good financials, you have to have a good customer rating, and customers have to like your products or services, right? But in order for the customer to like your products and services, you have to have internally good process, right? This means having a good quality product in the value chain, right? Improving the marketing campaign, improving the cost control, everything related to the value chain in the business, related to quality, costs, and everything, or time, right? They are all related to internal process. But in order to have an internal process, you have to have a good people. In order to have a good people, you have to teach them well. That's related to the learning and growth, right? So you have to have the indicators based on these 4 different perspectives. So clearly the good part of BSC is that you can capture a broader view of the business performance, not just linking financial, but also non-financial. You can also link performance into not only short-term, like earnings, but also long-term. Even the stock returns, annual stock return, or 3 or 5 year ahead stock returns can be the long-term performance measure in BSC. Good thing about BSC is that it involves every stakeholder in the business, not just investors or debt holders, but also, as said, the customers, employees, labor unions, suppliers, all those people, even the government. BSC is also flexible because, you can choose many key performance indicators. Oh, by the way, key performance indicator is the KPI. You have a flexibility in terms of what you choose. But there's clearly a downside of BSC, which is that if it's too many if you have too many KPIs, then it is really hard to control. And you may actually lose the focus on which key performance indicators we have to focus on, right? It's too complex. And we need a balance between the 4 perspectives, which is not easy. Which perspective are we going to focus on? That is debatable. And every people has every different opinion in an organization. And even the top management still may be concerned with financial performance, meaning that even if you have BSC, it can be a window dressing strategy where you show investors that you're taking care of all the 4 indicators, but actually you may be only fixated on, improving financial performance. Okay, so balanced scorecard is about not only financial, it's also about non-financial. It's not only including objective measurement, it also includes subjective ones. So you can also apply the subjective evaluation here. It's not only about past financial measures, it's also about future learning, future growth of a company. It's not just about output, how many units of product you sold. It's about innovation of the process, how efficiently you can manage time or cost. It's not just about short-run measures. It's also about long-run performance measures. Okay, so this is something that you don't have to know everything, but the core things that I have highlighted here, right? So you start with top-down mission and vision of the company, and you can make more, statements within the vision or mission. This is not a must for every company. Every company have different strategies and the ways they set BSC. It's not all the same. This is just one example, okay? But the core common thing for every company is that they have the mission and vision of the company. With that in mind, they also have strategy, right? So for each strategy, they have objectives. So what are they gonna achieve to attain vision, right? So objective can have different words for different companies, right? But essentially speaking, if you have a mission and vision, then you have to have a strategy and objective on what to do, right? And destination is about where we are and where we want to be. So it's about where, okay? Strategy is about what to do or how, right? How to do. Measure is also about how, right? How to measure. So the important metric is the KPI, right? From these 4 different perspectives that I have shown you. And then after having the measurement, every company segments and center managers have to taken action, right? Towards meeting the target that we have set in the KPI, right? So in the measurement part, we have the target. And the action part, we will have the actual outcome, right? So the actual outcome will be then compared with the target. And then we will reiterate the process and saying, okay, so in order to achieve the destination, how are we going to meet the target? How are we going to set the target, right? So these are all processes that are going on and on and on. This is just to show you one example strategy map. Strategy map shows all of these destinations, strategies, metrics, KPIs, all together. Okay, so this is one hypothetical online furniture showing mission and vision. This is showing the objectives, right? And the targets. They are broken down into these 4 metrics. Importantly, you have to make some links. Okay, so for example, in order to increase profitability, what you need to do, you need to increase the customer satisfaction. In order to increase customer satisfaction, you need to build quality in your process, right? Better quality product, better customer satisfaction. But in order to have a great quality, you have to have good employee. And you have to have a good leader, right? So all these are linked together. For each processes, for each perspectives, you have the KPIs, the targets, right? And what are the mini projects you need to do to keep those targets, right? Okay, now I want to show you some cases on EVA. Okay, so this is not on our textbook, but this is on a book called The Fair Pay by professor called Jae-Yong Shin at Seoul National University. This is actually a very good book to start with to learn more about compensation. And I want to bring a case on SK Hynix and Samsung. So SK Hynix is a semiconductor supplier, right? They are specializing in memory chips and the image sensors. So in 2021, there was a big spike in the operating profits of SK Hynix, right? Though the operating profit actually doubled from 2019. Okay, so employees have actually expected their bonuses to also double, right? But despite the sharp increase in the income, the performance bonus of individuals remained flat, which was around 20% of annual salary. Okay, so in 2019 it was 20% of the annual salary. 2020 was also 20%. So one of the bold employee in the SK Hynix sent a company-wide email to to all the employees and to the managers, saying why their performance bonus remained flat. And he questioned how the bonus is calculated. Why does it remain flat? Right? So it triggered a widespread discussion among employees, including the Gen Zs, right? Demanding a more transparent criteria for the bonus calculation. So why was it debatable? Because compared to other competitor, Samsung, where they reportedly say they pay bonus equal to 47% of annual salary. So that gave a feeling of some deprivation among the SK hynix employees. Okay, so you see what's going on. So after this February 8th, so let's say the SK hynix, I don't remember exact date when the SK hynix employee sent an email, but let's say it was before February 1st, okay? So before February 1st, the employee sent that company-wide email, and then a few days later, the chairman, Choi Tae-won, announced that he would return all the salary for 2020 to mitigate the concern and, some dissatisfaction among employees. And then one day after, the CEO, Lee Seok-hee, issued an internal explanation on why they have paid flat. Okay. So he acknowledged that employee can have concerns. So he said that they were gonna make some reforms to how they're gonna pay performance bonuses to the SK hynix. And then 2 days later, the official reform plan announced, saying that they're now going to improve bonus calculation by shifting from unclear calculation of EVA to clearer profit-based metric. Okay, so instead of let's say they have paid like 10%, was it 10? I think it was 20%. Yeah, 20% of EVA to the employees. How about 10% of a more clear metric of operating profit? Okay, so they shifted from EVA to the profit-based metric that is more clearly shown to the employees, right? On top of that, they said they will provide employee stock ownership grant as well as some welfare point payments. And then in February 10, labor and management have made an agreement to allocate 10% of the operating profit as the basis. Okay. So this is the statement from Lee Seok-hee at February 2nd. So you can also take a look at it. So one thing to note is that in 2020, the profit was 5 trillion won. After subtracting corporate taxes and cost of capital, 20% of the EVA was allocated to the performance bonuses, right? So then, even before these reform plan announced, we want to debate on whether the EVA calculation was really not fair, as the employee has said. So let's really go back. Let's wire back to 2020 and see how the EVA was. Okay, so the EVA is calculated based on after-tax OI, right? The NOPAT. So in 2020, the OI was 5 trillion won. The tax is 20%, hypothetically. And let's say the weighted average cost of capital WACC is 8%. Total minus the current liabilities is going to be 52 trillion based on financial statements. Okay, so then what we actually see is a negative EVA. Wow. So even if we make a conservative number for 8% or tax, EVA was actually a loss, showing a loss. And even showing a loss, SK hynix managed to share profits to the employees, right? So with this calculation, SK Hynix should have not shared any profits to the employees. So based on this calculation, we shouldn't say the flat bonus was fair. It was not fair. Actually, they got a favorable treatment. Then what do you think happened? So the author of the book assumes that there may be some adjustments in this part, right? So WACC, weighted average cost of capital, may have been calculated like 5 or 6, some adjustments, right? Or they may have excluded, some part in total assets to make it lower, or include more in current liabilities. So they may have made some adjustments so that they can face higher than 0 EVA, so that they can pay to the employees. So I'm not, for or against what the SK Hynix have done, but if this is true, then the employee's statement being that the SK Hynix having given them unfavorable treatment is false, right? Let us also look slightly to the Samsung Electronics part. Samsung, I'm not reiterating what they are. They have a lot of division: mobile, MX division, network division, memory division. Unlike the SK Hynix, they actually allocate what's called the overall performance incentive, OPI, which is the huge part of the bonus for the employees. Okay? And actually, this is not a company level EVA like the SK Hynix. It's based on division. So they allocate 20% of divisional EVA, right? Which is quite huge. Well, actually, there are 3 monetary incentives for Samsung employees. The special bonus that they can get for exceptionally outstanding performance, but that is non-regular. So employees do not expect much about special bonus. TAI is about the target achievement incentives, which is equivalent to about 200% of the monthly base salary. So this is also not that huge, even if you get awarded. But the more important part is the divisional level incentives. So the implication of the OPI is that if you're a high-performing division like the semiconductor MX or visual display, then they will get much higher pay, equivalent up to 50% of the annual salary. So depending on which division you're in, you may be a highly compensated employee or not, right? So for example, OPI is usually paid in late January and early February, whereas the TAI is paid at July and December. But let us focus on the OPI. Okay, so you can see that the OPI is really, really huge for these high profit divisions like wireless or visual display, but not for the battery. See, only 1.2%, 1 to 2%. So perhaps the employees in the battery division may not be very motivated to work really hard compared to wireless divisions where they can get a lot, right? And related to the EVA calculation, Samsung takes a more conservative approach by saying, hey, we are going to apply only cost of equity, but not cost of debt. Why? Because cost of debt is usually lower than the cost of equity. So typically, if the cost of equity is like 15%, cost of debt would be like 7%. So if you apply both, then the WACC would become like 8%, let's say. But if you only apply cost of equity, then your EVA goes down, right? So Samsung is intentionally making the divisional EVA lower so that they can pay lower, presumably. And regardless of the business performance, the maximum bonus payout is capped to be 50% of annual salary, no matter what. One interesting part is that there is also an individual level incentives. So OPI is a divisional level incentives, but it can be adjusted by each person. So if it's a high performer employee, then you can actually get up to 140% of the divisional OPI rate. Meaning, if your division OPI is 50% and you are a high performer, then 140%. So you can even get 70% of the annual salary. Okay. Whereas you're a low performer employee, so your divisional OPI rate is 50% and your individual rate is 80, so it's going to be 40%. Okay. So there is some individual flavor also in the incentives. Yeah. So this was something that I wanted to show you, that the company performance evaluation may differ side by side. Okay. And it would also differ different. It would also be different on wherever you go. Okay, so I'm gonna stop here, and next class we are going to talk about transfer pricing.